It's 2025 and gone are the days of the 4, 3, and 2% interest rates. You're probably staring down a 6, a 7, or an 8% mortgage rate and you're thinking, holy crap, there is no way I'm going to be able to buy a house anymore, right? It's too expensive. The monthly payment's too high. There's all these other reasons you're going to come up with for why you can't buy a house. Luckily for you, I've got some advice. Today, I'm going to talk about 3 different ways that you can purchase a house with little or no money down and also take advantage of a super low interest rate that somebody else got back in 2020 or 2021. If you're interested in hearing about this, stick around to the very end where I share an example of how I bought a house for less than $2,400. Let's get started. First things first, let's talk about a loan assumption. I already did a pretty extensive video on this about how to assume someone else's loan. So check out the video in this link, and that should get you up to speed on loan assumptions. Because I've already done another video on that, I'm just going to hit the high level points to make sure that we're all on the same page. In short, a loan assumption is where you have the mortgage of the property in the seller's name, and you scribble out the name on the mortgage document and write in your name instead. Now, the benefit of this is that you get all of the original terms of the mortgage. You get the interest rate, you get the loan payoff period, you get the loan balance, and all that is awesome. There are some downsides to this though. First of all, there are only a couple different types of loans that are assumable. Those 2 types of loans are VA loans and FHA loans, both of which are backed by the US government. The benefit of assuming someone's loan is that you get to keep all of the loan terms. So if someone got a mortgage in 2020 or 2021, and their interest rate is 2.5%, and you assume their mortgage, that's awesome. Now you have a loan that has a 2.5% mortgage rate. That's going to be super affordable. The problem here is if you're assuming a VA or an FHA loan, you have to meet the original requirements of the loan when it was originated. What does that mean? What that means is that you have to intend to live in the property and you have to meet the debt to income ratio requirements of the lender. There's also probably some nitty-gritty details that the lender hasn't publicized that you may also need to meet. A loan assumption is going to be an awesome option for someone who's looking to buy their own house to live in. Because a VA or an FHA loan is designed for a primary residence, so someone who's going to actually live in the house, there is a lot of benefit to being able to buy your own house with effectively someone else's loan. The drawback of this is that if you're assuming someone's loan, you're only making up the portion of the purchase price that's covered by the loan balance. If I have a $300,000 purchase price with a $200,000 loan balance, that means that I have to make up that $100,000 of equity somehow or some way. This is where assuming someone's loan can be a little bit prohibitive, particularly if you don't have a ton of cash just laying around the house. But what is someone to do if they want to assume someone's loan or take advantage of their interest rate or their loan terms, but the loan is not an FHA or a VA loan? Enter subject to home purchases. You might have heard this term before of a subject to mortgage, and the short version of what a subject to purchase is that you are purchasing the property subject to the existing loan. There are a lot of people who get a little confused about this. When you purchase a house, there are 2 different things that go into it. The first thing that goes into it is the deed or the title. The deed/title is what gives you legal ownership in the property. Now, because you don't have $200,000, $300,000, whatever your purchase price is, you go to a lender and the bank or the lender will give you almost all of that money. Some loan types you get to get all the money, other types of loans you have to put some percentage down. The mortgage document is a separate document from the deed. And this is all for South Carolina, where I'm a real estate agent. There are other states that have slightly different terms for mortgages. Sometimes it's called a deed of trust, but what I'm talking about is specifically for South Carolina. Going back to our discussion, you have the deed on one hand, which gives you equitable interest in the property, meaning you own the property. But then you have to have someone finance the property, which is what the lender does. If you're purchasing a house subject to the existing mortgage, what that means is that you are transferring ownership via the deed to someone else, but the loan or the mortgage on the property, that stays in the original seller's name. In this case, a lot of people refer to this as taking over someone else's mortgage payments or making payments on behalf of the original borrower. Going back to our discussion, what type of loans are eligible for subject to purchases? The answer is any type of loan is eligible for a subject to purchase. Because you're making payments on behalf of the original loan owner, there's no requirement for it to be an FHA loan or a VA loan or a conventional loan. Pretty much any type of loan is eligible for this type of purchase structure. The nice thing about purchasing a property subject to the existing mortgage is that there's no requirement to meet the original conditions or the original requirements of the loan that was originated. So if I purchase a house that has a VA loan on it and I purchase it subject to the existing mortgage, I still get that VA loan, but the VA loan stays in the seller's name, and then I will make payments on their behalf, which means that I don't necessarily have to be living in the house, which would be a requirement if I were to assume the VA loan instead. What this means for real estate investors is that this is a great way to purchase properties and get an awesome interest rate while not having to actually live in the property. If I were to assume a loan, I would have to live in the property in order to qualify to assume the loan. If I were to purchase a house subject to the existing mortgage, I don't have to live in the house. So that's a huge benefit for anyone who wants to have a rental property that still has an awesome low interest rate or very favorable loan terms. Purchasing a house subject to is not without its risks, though. It's not all just fine and dandy, so I can't just go out and purchase any house subject to, and then that's that, and there's no real consequences. Some of the downsides of buying a house subject to are that because the loan is staying in the original purchaser's name, that loan will very rarely come off of that person's debt to income ratio. So you need to have a way to show that the loan is either being paid for them or to transfer the property into a land trust where they have a part ownership. There's a couple different ways to get around that part of it. The second risk of purchasing a house subject to is the risk of having the loan called due. Most of mortgages nowadays have a clause in there that says if the ownership of the property is transferred, that the bank has the option, not the requirement, but the option to make the note or the mortgage due and payable immediately. That means that month one, my mortgage payment is $1,500, for example. The bank calls the note due. That means that note two, my mortgage payment that's going to be due, is the entire remaining balance of the loan. In my experience, there are very few loans that actually get called due because of the due on sale clause. And even if they do get called due and the note is required to be paid in full, usually the lender is willing to work with you provided that their mortgage or that their liability is secured by the asset that's connected to it. So as long as there is a property that's in good condition and someone is making payments on the loan, they usually are not interested in foreclosing on the property or calling the note due. That's going to be a bunch of headache for them. So far, we've talked about assuming a mortgage and purchasing a house subject to. These are both ways to purchase a house where there is already debt that is on the property. But what about if they're purchasing a house that doesn't have any debt on it? The previous owner has paid off all the mortgage and they own it free and clear. What are some options there? Enter seller financing. In the case of seller financing, the only real difference between a normal purchase of a home and a seller finance purchase is that the seller themselves is acting as the bank. So instead of signing a mortgage document for First Mortgage Bank or United Wholesale Mortgage or whoever may originate the loan, you sign a mortgage document with Joe Schmo, Joe Smith, right? Whoever it is who owns the property before you. That just means that you're making payments directly to the seller instead of going through a bank. In a lot of cases, seller financing can be very advantageous to the seller. For example, they only have to pay taxes on the portion of the sale of the property that they have received in that year. For example, if I were to sell a $200,000 house and I owned it free and clear, that means that I would be taxed on all $200,000 of the sale price. However, if I were to sell or finance that house to someone and I were only to collect, let's say, $20,000 worth of payments that year, well, now I'm only being taxed on $20,000 instead of $200,000. That's a huge difference, right? We're talking about $180,000 of taxes or of taxable income that are now off my tax return. That's pretty nice for the seller. The portion of this topic that's on seller finance is going to be a little bit shorter because it is a slightly more simple process than assuming a loan or purchasing a house subject to. Now, there is one more option that I didn't mention yet, and that is you can combine one or more of these options. So what that may mean is maybe I purchase the house subject to the existing mortgage, but the seller also wants to get some monthly payments. So what I can do is I can buy the house subject to, so I'm making payments to the lender, and then I have a separate mortgage note where I'm paying the seller directly monthly payments on top of the normal mortgage payment that I'm making to the lender. Last thing I want to cover in this video is an actual example of when I purchased a house subject to the existing mortgage. And this might actually blow your mind. So the scenario was I had a client who was looking to list his house, and because of the market conditions in his neighborhood, if he listed his house on the market, he was risking losing $10,000 or maybe making $10,000. But there was an equal chance of both of those things happening. So he was nervous about assuming some of that risk. So what I offered for him to take zero profit from the house, but I would purchase the house, fix it up, and then sell it after he moved out. What that meant for him is he gets to walk away, and although he doesn't get any profit from the house, he has zero risk of losing any money because he doesn't have to pay off his loan. He doesn't have to pay any realtor fees. He doesn't have to pay any attorney's fees. So it's really a pretty good option for him, and he's really excited about it. For me, when I purchased the house, because my agreement with the seller wasn't for me to pay him anything on top of what he owed for the mortgage, the only costs that I had to cover were closing costs. In this case, I covered both the buyer's closing costs, which are my closing costs, and I also covered the seller's closing costs. So all in all, that came out to about $2,300. That's the first time in my life I've ever bought a house for $2,300, and it was pretty mind-boggling. I was signing the final documents and thinking, holy crap, there's no way this is real. But I can assure you it is in fact real. My name's on the title, my name is on the deed, and yeah, that was definitely a light bulb moment for me. If you're interested in hearing about loan assumptions and how I tried to assume one of my friend's loans, but it ended up not working out well because of the specific requirements for the lender, you can check out my other video on loan assumptions right up there. So a quick recap of what we talked about today. We talked about 3 different types of ways that you can purchase a house without using a traditional mortgage lender. The first way was a loan assumption, where you scribble out the name of the previous borrower on the mortgage note and write in your own. In this case, you have to meet all the requirements of the original loan origination. So if it's a VA loan, that's meant for a primary residence homeowner. That means I have to live in the property or intend to live in the property when I assume that mortgage note. The second way is purchasing a house subject to the existing mortgage. In that case, I'm making payments on behalf of the seller or on behalf of the previous owner, so I don't necessarily have to meet the original requirements of the original loan. So for example, if I am purchasing a house subject to a VA loan, then I don't necessarily have to live in the house in order to continue making those payments on the behalf of the previous owner. The third and the last type of finance that we talked about is seller finance, and this is pretty straightforward. This is just where instead of making your payment to a bank, you're making your payment directly to the seller of the property. I went years and years and years thinking there's only one way to buy houses, and that way is to use a conventional mortgage with a conventional lender and go through the whole normal purchasing process. And to be totally honest, that's simply not the case. A lot of this stuff I've only learned about in the last couple of years, but I have actually put it into practice, and I'm happy to share my experiences with each of those practices. If you like this video, check out some of my other videos on loan assumptions, whether you should purchase or sell, whether you should buy or rent, whether you should sell or rent your house when you move out, and also all about taxes. And as always, if you don't want to miss a new video drop, check below and make sure you like and subscribe for more videos.